Berkshire Hathaway's business model is widely respected because it combines long-term investing, decentralized management, and careful risk management to steadily build value over time. The key to their success is how they allocate capital. Rather than just running businesses, they focus on making disciplined investment decisions, using insurance float as a cost-effective source of capital, investing only when returns meet strict criteria, maintaining cash reserves for flexibility, and preferring to reinvest profits in strong businesses rather than paying dividends or taking on debt. This shows that capital allocation should be a priority for CEOs, not just a finance role. Additionally, Berkshire owns a diverse range of durable, cash-generating businesses across industries like insurance, rail, and retail. They choose companies with strong competitive positions, predictable cash flow, and consistent profitability, avoiding those that need frequent turnarounds or heavy restructuring. This approach creates a stable, high-quality portfolio that supports long-term growth through compounding. Insurance plays a crucial role in Berkshire's financial strength because underwriting generates what's called float, money held temporarily before claims have to be paid. When underwriting is done profitably, this float effectively turns into free capital that can be invested in stocks, acquisitions, or other growth opportunities. This highlights the value of creating or acquiring a business unit that produces low-cost capital, which can then fund long-term investments. Another key aspect of Berkshire's model is its decentralized structure. Subsidiaries operate almost independently, with minimal oversight from headquarters, which remains surprisingly small for such a large company. This trust-based approach attracts skilled managers and reduces bureaucracy, allowing leaders to make decisions quickly. A long-term perspective is also central to Berkshire's success. Warren Buffett rarely sells businesses or stock unless there's a fundamental problem, deliberately tuning out short-term market fluctuations and quarterly earnings pressures. This patient mindset focuses on intrinsic value and compounding returns over decades, which provides a strong competitive edge. Despite its size, Berkshire is very conservative with risk, avoiding heavy debt and speculative moves while maintaining large liquidity reserves to handle downturns. Decisions are always grounded in intrinsic value, not market hype, which builds resilience and options for the future. Finally, the culture at Berkshire underpins all these strategies, emphasizing integrity, rational thinking, and a focus on performance rather than internal politics. The company avoids chasing trends and sticks to its consistent philosophy, which strengthens its overall business model. A key lesson from Berkshire Hathaway is that culture should support the strategy rather than work against it. Their model combines operating earnings from fully owned businesses with investment income from equity stakes and fixed income securities. This approach creates two income streams that are not closely related, helping to stabilize performance through different economic conditions. Another important point is how Berkshire handles share repurchases. They only buy back shares when they are priced below their intrinsic value, ensuring that buybacks increase long-term per share value rather than being done for appearance or short-term market reasons. Overall, Berkshire's success comes from disciplined capital allocation, decentralized management, long-term thinking, conservative risk management, and a culture based on trust and rational decision-making. While no one can replicate Berkshire's exact model, these principles can guide any business or investor aiming for steady, compounding growth over time.